Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description. Moving on to the cost of capital. Once again, important topic in finance and in the curriculum. Highly likely to be on exam day, so we are going to go through the key two topics here, which are one, the WACC or weighted average cost of capital of a company. And, quick summary, a WACC is essentially a weighted average of a company's cost of debt, cost of preferred stock, and cost of common stock. So it's used as a measure of the firm's, combined cost of capital given its capital structure decisions. So like how much debt it has, how much preferred stock, how much common stock, and the weights of all of those in the company's respective capital structure. We're going to calculate WACC a couple times. We're going to be given some information how to calculate like the cost of debt using some yield to maturity metrics, which you'll be familiar with in from the very first learning module, time value of money. And then common stock, we also have a pretty common model, which I don't believe you've seen yet, which is the CAPM model, which is a simple formula used to calculate or estimate the required return on common stock. From there, we're also going to be talking about beta. Beta, as we know, is essentially a measure of a company's sensitivity to market volatility. And we're going to be talking about two different types of beta. One is the unlevered beta, and the other is the levered beta. We'll go into it in a bit more detail, but quick summary once again is that the unlevered beta measures that sensitivity that I just mentioned without capital structure decisions, so it strips out debt and equity of a company and just looks at its asset beta. The unlevered beta is also known as just assets or asset beta, assuming that the company's operations are fully funded with just equity, no debt. And then we'll also continue on with levered beta, which is a subset or a continuation of unlevered beta, in which we're actually, adding back the debt to equity or capital structure decisions of the company to come up with, arguably a more reliable measure of beta that actually incorporates, financing decisions and funding decisions of a company. So we're just going to jump right into the questions now. The gearing company has an after-tax cost of debt of 4%, a cost of preferred stock of 8, cost of equity capital of 10, and a weighted average cost of capital of 7. The company intends to maintain its current capital structure as it raises additional capital. In making its capital budgeting decisions for the average risk project, the relevant cost of capital is it's going to be the weighted average cost of capital of 7%. Once again, for when applying discount rates or deciding on a discount rate to apply to a specific capital budgeting project, you take the discount rate that is applicable to that project usually, or the opportunity cost of capital, kind of the same thing. In this case, there's two things that lead me towards this 7%. One is that they want to maintain their current capital structure going forward, and two, that the project is average risk. So average risk, typically take the weighted average cost of capital. If this was a higher risk project, then you could adjust this upwards to maybe like 10% or something. But in this case, everything is average, current capital structure, so you take the WACC. Fran McClure of Alba Advisors is estimating the cost of capital for Frontier Corporation as part of her valuation analysis. The analyst will be using this estimate along with projected cash flows from the company's new projects to estimate the effect of these new projects on the value of the company. The analyst has gathered the following information on the company. So we have book value of debt, market value of debt, book value of equity, market value of equity for the current year and the forecasted year. The weights that the analyst should apply in estimating the company's cost of capital for debt and equity are, well, when you have market value of equity and debt, you use it. Sometimes you don't have it. In that case, a lot of times analysts would just use book value, especially for like private companies. But when you have market value, that's that takes priority over book value. And then secondly, when you have forecasted results or forecasted for next year, typically you wouldn't have this in most cases, like forecasted values from the company. Typically, companies will give guidance on like revenue and EBITDA, but not, you know, capital structure for the most part. Um, but in this instance, we're given it. So the information that takes priority is forecast if they're reliable and market value. But typically, you would just have current year book value. But like I said, this information we have it, so it will take priority over the other stuff. So we're asked, so the weights that the analyst should apply. Yeah, okay. So we need to calculate the weights of debt and weights of equity. So the weight of equity is going to be this 220, so the forecasted market value over the sum of that and the market value of debt. So for equity, it's going to be 220 over 220 plus 63. And then we could also, just take 100% minus this answer, but um, for debt, we could, run the calculation as well, and it'll all sum up to 100. So equity, debt. Debt is a 63 only over the 220 plus 63. And if we run this out, we get a weight of equity of 0.777. And then the weight of debt is going to be, 1 minus that, so 0.223. And our answer is C. Couple questions here. An analyst assembles the following facts concerning the company's component cost of capital and its capital structure. So this gives the cost of equity based on the CAPM model, pre-tax cost of debt, tax rate, and the weights of equity and debt. And we need to calculate the company's WACC. So we have the weights. We just got to, well, if we look at the formula for WACC, we have a bunch of stuff already. So weighting of debt and the cost of debt plus the weighting of equity and the cost of equity. So what do we have? We have this, we have this, and we have this. But we need to find, we have the pre-tax cost of debt, but we need the after-tax cost of debt, right? So we can find that here. So the cost of debt is going to be the 8.28 times 1 minus the tax rate, which is 30%. And if we do that, we get, one sec, 5.796. So now we can sub all this in and solve for WACC. So the WACC is going to be the weighting of debt, which is 20, 0.2, times the after-tax cost, which is 5.796, plus the weight of equity, 0.8, plus the cost of equity times 15.6. And we get a WACC of 13.64%. No multiple choice on this one, just written response. So we're all good. And then for the next one, the cost of equity is equal to the expected market return. Nope. This is, the market. It's not related to individual equity. B, the rate of return required by stockholders. Yep, that's the answer. .com, interesting, has determined that it could issue 1,000 face value bonds with an 8% coupon paid semi-annually and a 5-year maturity at 900 per bond. If the marginal tax rate is 38%, the after-tax cost of debt is closest to what? So we need to find the pre-tax cost of debt, which is going to be the yield to maturity on this bond, right? So this is going back to the first module, time value of money. And what do we got? So we're going to have to use our calculator here. Future value is 1,000. That's easy. The payment is 8%, but semi-annually. So 8% of 1,000 is 80. So half of that is 40. N is going to be 10 because we have 5-year maturity, but semi-annual. So 2 periods per year. So N is 10. And the present value we are given is 900. And if we run all of this, we got to compute I/Y, or the interest rate. and we get a yield of 5.3% around that. But this is the um, semi-annual yield, right? Because what we're doing, we have 10 periods in here, but it's a 5-year bond. Like we've adjusted everything to be semi-annual. So we can just, do quick math and multiply this by 2, and we get a annual yield of around 10.6%. And now we got to calculate the after-tax cost of this. So 10.6% times 1 minus the tax rate, which is 38%. And we get a value of 6.59%. So the after-tax cost of debt is 6.6, which is C. At the time of valuation, the estimated betas for JP Morgan and the Boeing company finally got some real company names. So we got betas of 1.5 and 0.8 for each. The risk-free rate of return was 4.35%, and the equity risk premium was 8.04%. Based on these data, calculate the required rates of return for the two stocks using the CAPM model. All right, so CAPM model is really important, almost guaranteed to be on the exam in my opinion. And basically this is just a pretty simple formula used to calculate the expected return on equity or the cost of equity. And to do that, we have, like I said, the expected return or the cost of equity is equal to the risk-free rate plus beta, the beta of the stock, times the expected return on the market minus the risk-free rate. So you notice that this right here is actually the equity risk premium. Expected return on the market minus the risk-free rate, that's, your equity risk that you're taking on. So we can, use the information that we have to calculate the answers here. Let's do JPM first, JP Morgan. So we got a cost of equity of what's the risk-free rate. So we can just sub in here, right? So 4.35 plus their beta was 1.5 times equity risk premium is 8.04. So that's this entire thing, right? I mean, you can back calculate the expected return on the market because we have the risk-free rate, but in this case, we're just given this everything in the brackets here. And we get a expected equity return of 16.41%. So that's their cost of equity. And then Boeing's going to be the same concept where we got same risk-free rate, got a different beta, so 0.8 times the same equity risk premium, 8.04. And if we do this, we get 10.78%. So you notice the only difference here is the betas of the two companies. And the higher the beta, the more sensitive a stock's performance is to the market. So generally here, like if the market increases 10%, JP Morgan is expected to increase 15%, while Boeing would just increase 8%. So it's kind of like a correlation of the stock price return with the market. All right, really quickly before we jump into this one, just wanted to show the formulas for unlevered beta and levered beta and give a quick summary on them. So as we know, betas are a measure of an asset's or a stock's returns. It's a measure of its sensitivity to market volatility. And there are two different types of betas. One is unlevered or asset beta, and the second is levered or equity beta. And the only, like we have these formulas here, but really what we're trying to do here is an asset beta measures, like I said, that sensitivity to market volatility without capital structure decisions. And basically what that means is that we're adjusting the BE or equity beta here to strip out the debt of the company and assume that the assets are financed with 100% equity, right? Whereas the levered or equity beta here takes the unlevered beta and adds back the capital structure decisions. And you can see here from Like just by looking at this formula, if debt to equity ratio is higher, then the equity beta is going to be higher as well, right? Because all of this gets added in. So the more debt you have on your books, the higher your beta is going to be, your equity beta is going to be. Okay, so we can jump back into the question now. Brandon is a financial analyst covering the beverage industry. He's evaluating the impact of this company's new product line of flavored waters. Who cares? They recently had a debt to equity ratio of 0.6, so 0.6. The new product line will be financed with 50 million debt and 100 mil equity. Okay, so that's actually a new ratio of 50 over 100, so 0.5, right? In estimating the valuation impact of this new product line on DES value, the analyst has estimated the equity beta and asset beta of comparable companies. In calculating the equity beta for the product line, the analyst is intending on using the company's existing capital structure, so the 0.6, when converting the asset beta into a project beta. Which of the following statements is correct? So under A, using the company's debt to equity ratio using the company's debt to equity ratio of 0.6 is appropriate in calculating the new product line's equity beta. So not really, right? Blah, 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 blah. Their existing capital structure. Okay, so they're going through so the equity beta they're doing an equity beta just for the product line. So it doesn't really make sense to use the current debt to equity ratio of 0.6 because this new product line is going to be financed with the 0.5 that we just talked about. So this one's going to be incorrect. So you would adjust it using this 0.5. Using the company's debt to equity ratio of 0.6 is not appropriate. Rather, the debt to equity ratio of the new product 0.5 is appropriate. Yeah, so that's exactly what I just said, and that's your answer. An analyst gathered the following information about a private company and its publicly traded competitor. So we have private up top, public on the bottom, tax rate, debt to equity, and equity beta. The estimated equity beta for the private company, which we don't have, is closest to what? Okay, so this is a practical application of when you would actually have to unlever and relever a beta. So like a private company obviously doesn't have a stock price or like a stock price on the market. So you can't really accurately measure beta, right? Like there's not daily returns or stock price that you can use to run a regression to calculate beta. So here what you would do, and this is like commonly done in practice, is you take a public company, so a comparable public company, same size, same industry, same product line, or as close as you can get to the same, and you would take their beta and then adjust it with two steps. First, calculating the unlevered beta, and then second, calculating the levered beta to find this value right here. So first step, we have to unlever this 1.75 that we have here for the public company. So unlevered beta is going to be the beta of the company, the 1.75, the public company, times 1 over 1 plus 1 minus t. And the t is this company's tax rate, not our tax rate. So 1 minus 35% times the debt to equity ratio. Once again, this company's debt to equity ratio, which is 0.9. So very important when you're unlevering the beta to do it for that company, like the public company, not the company of consideration. So you're essentially stripping out the capital structure decisions of this public company, and then we're going to relever it using our tax rate, our debt to equity, right? So if we do this, we get a value of 1.1104 or 1.104. Great. Now we have this, which we can plug in for step 2. So now our equity beta, which is what we want to calculate for the private company, is this 1.104, the unlevered beta, times 1 minus our tax rate, so the private company, yeah, private company's tax rate. I'm just going to simplify here. 1 minus 30% is 0.7 times our debt to equity ratio of 1. So yeah, you can just remove that because it's times 1. So then we do this and we get a levered beta or equity beta of 1.877. So that's our answer C.